I'm recording this at a moment that feels almost surreal, Saturday morning, and the precious metals world has been turned completely upside down. What transpired over the past 2 days isn't just another market correction or a routine pullback that traders shrug off by Monday. No, this is something entirely different. This is the kind of event that gets written about in financial history books, the kind that people reference decades from now when they talk about market chaos and once-in-a-generation opportunities. Silver just experienced its second worst trading day in recorded history, and I need you to understand the gravity of what that means before the opening bell on Monday morning. Let me paint the picture for you. In a single brutal trading session, silver plummeted 31%. Think about that number for a second. 31%. Assets don't just evaporate at that rate without something fundamental breaking in the system. This wasn't a gradual decline over weeks or months. This was a free fall that happened in hours, with prices collapsing from the mid-80s all the way down to $65 an ounce. The speed was breathtaking. The violence was unprecedented. And the aftermath has left the entire precious metals community reeling, trying to make sense of what just happened and, more importantly, what happens next. But here's where it gets even more interesting and, frankly, more confusing for anyone trying to navigate this market. After that catastrophic crash, silver didn't just lie there defeated. It came roaring back with a vengeance that's almost as stunning as the crash itself. Today, we're looking at a 10% bounce from yesterday's close, which means silver has rocketed nearly 20% off those terrifying lows around $65. Right now, as I'm speaking, silver is trading at $77.98. This kind of V-shaped recovery is extraordinarily rare in commodity markets, and it tells us something critical about what's happening beneath the surface. The damage wasn't confined to silver either. Gold crashed 11% during the same time frame. But the real story, the one that should make your jaw drop, is what happened across global markets as a whole. Analysts are estimating that somewhere between $6 and $15 trillion in value was wiped out across all asset classes. Yes, trillion with a T. This was a spectacular unwind of leveraged positions, a cascade of forced liquidations that swept through every corner of the financial world like a financial tsunami. Margin calls went out by the tens of thousands. Traders who had been riding high on leverage suddenly found themselves underwater, forced to liquidate positions they never wanted to sell, at prices they never imagined they'd accept. So what triggered this absolute carnage? The Chicago Mercantile Exchange, the CME, raised margin requirements on precious metals futures contracts by 37%. Now, if you're not familiar with how margin works in futures markets, let me explain why this is such a big deal. When you trade futures, you don't put up the full value of the contract. You put up a fraction, called margin. This allows traders to control large positions with relatively small amounts of capital, which is great when markets move in your favor, but catastrophic when they move against you. When the CME suddenly raised margin requirements by 37%, it meant that traders who were already fully leveraged had to come up with massive amounts of additional capital immediately or face forced liquidation of their positions. Most couldn't come up with the cash fast enough. The liquidations began, and once they started, they fed on themselves. Each forced sale pushed prices lower, which triggered stop-loss orders from other traders, which created more selling pressure, which pushed prices even lower, which triggered more margin calls, and around we went in a death spiral that erased 31% of silver's value in what felt like the blink of an eye. This is what happens when leverage gets flushed out of a system all at once. It's violent, it's indiscriminate, and it leaves destruction in its wake. But now comes the part that should have every serious investor paying very close attention. Despite this historic crash, despite the forced liquidations and the margin calls and the terror that gripped markets on Thursday, silver is bouncing back with remarkable strength. That 10% gain today isn't happening in a vacuum. There are real forces at work here, real dynamics that suggest this crash may have been more about paper market mechanics than actual fundamental deterioration in the silver story. In fact, when you look at what's happening in the physical market right now, you start to see a picture that's radically different from what the paper spot price is telling you. Let me give you some numbers that should make you sit up and take notice. In Asian markets right now, physical silver is commanding premiums of $20 to $50 over the paper spot price. Read that again slowly. Physical silver, the actual metal that you can hold in your hand, is trading for $20 to $50 more than what the futures market says silver is worth. That means while paper says silver is worth $77.98, actual physical transactions are happening at $96 to $127 per ounce. If you go to try to buy Silver Eagle coins right now, you're looking at prices ranging from $95 to $165 per coin. These aren't minor premiums. These are premiums of 25 to 100% over spot price. What does that tell you? It tells you that the people who actually deal in physical metal, the dealers who see real supply and demand every single day, don't believe the paper price reflects reality. They're not just charging these premiums because they're greedy. They're charging them because physical metal is genuinely scarce, and they know that if they sell at current paper prices, they won't be able to replace their inventory at anything close to those levels. In fact, many dealers have gone into what they're calling sales-only mode. They'll sell you silver if you want to buy, but they absolutely will not buy it back from you. They're hoarding inventory. They're preparing for a world where physical silver becomes dramatically more valuable than current paper prices suggest, and they want to make sure they have metal on hand when that reality becomes undeniable to everyone else. The situation in China adds another layer of complexity and concern to this whole saga. There's a Chinese silver fund that collapsed 40% in value and had to halt trading entirely. Chinese investors are now locked inside positions they cannot exit, frozen in place while the market churns around them. The carnage in Chinese markets has mirrored and amplified what happened globally, creating a feedback loop of fear and forced selling that's still reverberating through the system. So here we are on Saturday morning, looking at a market that crashed 31%, then bounced 10% in a single day. A market where paper prices and physical prices have diverged by 25 to 60%. A market where trillions of dollars have been destroyed and positions are being frantically rebuilt on foundations that feel anything but solid. And the question everyone is asking is simple: what happens when markets fully reopen on Monday morning? This is why Monday specifically is so absolutely critical to understand. The crash happened Thursday. Friday saw continued wild swings in volatility. Today, Saturday, the physical market is processing what happened. Dealers are adjusting their pricing. Investors are trying to figure out their next move. Tomorrow, Sunday night in the United States, futures markets will reopen. And then Monday morning, the full weight of global market participation will come crashing back into this situation. The weekend creates what traders call gap risk, which means prices can jump dramatically from where they closed Friday to where they open Monday, with no trading in between to smooth the transition. News doesn't stop just because markets are closed for the weekend. Developments can happen at any moment. Government announcements, geopolitical events, corporate failures, currency moves. Any of these things can happen while markets are shut, and when they reopen, all of that accumulated news and emotion gets expressed instantly in the opening price. Given the extreme volatility we just witnessed, given the massive positions that were liquidated and the uncertainty about what positions remain, that Monday opening gap could be enormous in either direction. Let me walk you through the scenarios, because understanding what could happen is essential to making good decisions about what to do with your silver holdings right now. If negative developments occur over this weekend, we could see silver gap down dramatically when Monday morning arrives. What kind of negative developments am I talking about? The CME could raise margins again. If they do, we'd see another immediate round of forced liquidations as traders who survived the first margin increase get knocked out by a second one. The selling cascade would resume right where it left off, and we'd be looking at prices potentially testing $60 or $55 or even lower. Another major silver fund could collapse. The Chinese fund showed us how quickly these things can unravel. If a similar collapse happens in Europe or the United States, panic could spread like wildfire through the investment community. Everyone would start wondering which fund is next, which institution is sitting on losses they can't sustain, and the rush for the exits would intensify. The dollar could spike unexpectedly. Remember, commodities are priced in dollars, which means when the dollar strengthens, commodity prices face mechanical selling pressure regardless of their individual fundamentals. A strong dollar move could hammer silver even if nothing else changes in the silver market itself. Stock markets could show serious stress when they reopen. The trillion-dollar wipeout in tech stocks earlier this week created margin calls that forced investors to liquidate their silver positions to meet those calls. If equity stress continues or worsens, we could see more cross-market liquidation hitting silver. Risk-off sentiment could return with a vengeance, and silver might get sold simply because it's liquid and people need to raise cash quickly. In this negative scenario, silver gaps down Monday morning, maybe to $70, maybe to $65, maybe lower. Stop-loss orders that are sitting in the system get triggered immediately. More margin calls go out based on the new lower prices. The whole cascade from Thursday resumes, and by the end of the week, we could be looking at silver testing $55 or $50. The second leg down completes the correction, and anyone who held leverage through the weekend gets absolutely destroyed. But there's another scenario, and it's exactly the opposite. In this scenario, silver explodes upward toward $100, and it happens fast. What would trigger this kind of move? Physical delivery stress becomes undeniable. If news breaks over the weekend about delivery failures at the COMEX or near failures that were barely averted, it would validate everything that physical premiums have been screaming at us. The paper market would have to reprice dramatically higher to match physical reality, because you can't maintain a situation where paper says $78 and physical transactions happen at $127. That gap has to close, and when it does, the paper price is going to rocket higher. Institutional buyers could announce major purchases. Imagine if a sovereign wealth fund or a major corporation announces that they're allocating significant capital to silver, buying the crash because they see it as an opportunity rather than a problem. That would signal to retail investors and smaller institutions that smart money is accumulating aggressively, and everyone would want to get in before prices run away. The buying pressure would be immense. Geopolitical developments could trigger safe haven buying. The United States and Iran are in talks right now. Tariff situations are fluid and could escalate. There are numerous global tensions simmering that could boil over at any moment. If any of these situations flare up over the weekend, silver would benefit tremendously as a safe haven asset, with investors rushing to protect their wealth from geopolitical uncertainty. Short covering could accelerate dramatically. The banks and large institutions with concentrated short positions just watched silver crash 31%. Some of them covered their shorts during the crash, taking profits on their bearish bets. But others are still holding short positions, and if they decide to cover more aggressively, their buying to close those positions would push prices dramatically higher. When shorts panic and rush to cover all at once, you get what traders call a short squeeze, and it can send prices vertical in a very short period of time. In this positive scenario, silver gaps up Monday morning, maybe to $82, maybe to $85, maybe higher. Shorts panic. The gamma squeeze in options triggers as market makers have to hedge their exposure. By the end of the week, silver tests $95 or $100. The crash is revealed to have been the final shakeout, the capitulation moment that had to happen before the historic rally could resume. Everyone who sold in panic on Thursday or Friday spends the rest of the year kicking themselves for not holding through the volatility. I want to be completely clear about something. Both of these scenarios are genuinely possible. I'm not exaggerating for dramatic effect or trying to get views with clickbait. The conditions in the market right now support either outcome. The crash was real, the rebound is real, the divergence between paper and physical prices is real, the option positioning that creates acceleration in whichever direction the market breaks is real. All of these factors are present simultaneously, and they're all pointing toward a violent resolution one way or the other. The middle ground is disappearing. We're much more likely to see $50 or $100 than we are to see silver just consolidate peacefully in the 70 to 85 range. The option mechanics make this binary setup even more explosive than it would otherwise be. There are massive call option positions at strike prices above where we're trading right now. There are massive put option positions at strike prices below current levels. When someone buys an option, the institution that sells it to them has to hedge their exposure to protect themselves. If silver moves up, market makers who sold calls have to buy silver futures to hedge. Their buying pushes the price higher. More calls go in the money, requiring more hedging, requiring more buying, pushing prices even higher. It's a feedback loop that accelerates upward. The same thing happens in reverse if silver moves down. Market makers hedging their short puts have to sell, which pushes prices lower, which brings more puts into the money, which requires more hedging, which means more selling. The cascade accelerates downward. There's no stable equilibrium in the middle because the hedging mechanics push prices away from the center in whichever direction they start to move. So what do? How do you position yourself for a situation where both $50 and $100 are realistic outcomes within the next week? Let me give you the principles that should guide your decisions, because making smart choices in the next 48 hours could be the difference between capturing generational wealth and suffering catastrophic losses. First principle, eliminate all leverage before Monday. I cannot possibly stress this strongly enough. We just witnessed what happens when leverage meets volatility in precious metals markets. A 37% margin increase destroyed leveraged positions instantly. Traders who thought they had plenty of cushion found themselves liquidated before they could even react. If you're holding any leveraged silver position going into Monday, whether it's futures, options that are about to expire, leveraged ETFs, anything with embedded leverage, you're gambling with your financial future. The gap risk alone makes leverage suicidal right now. If silver gaps from $77 to $60 when markets open Monday morning, your leveraged long position could be completely wiped out before you have any chance to react or adjust. If you're short on leverage and silver gaps to $90, same result, you're done. Close your leveraged positions before the weekend ends. Take whatever profit or loss you currently have. Do not carry leverage into Monday. This is not negotiable if you want to survive what's coming. Second principle, hold your physical silver regardless of which scenario unfolds. Physical silver that you actually possess in your own hands survives both outcomes. If we crash to $50, your physical is still sitting there, still real, still worth $50 per ounce. You haven't lost the metal. You haven't lost the long-term thesis. You just have to be patient while price recovers. If we spike to $100, your physical has doubled in dollar terms, and you can sell some if you want or hold for even higher prices. Do not sell physical silver before Monday hoping to buy it back lower. That's a trader's game, and the risk is asymmetric against you. If we spike to $100 and you sold at $78, you will not be able to replace what you sold at any reasonable price. Physical premiums will explode even more than they already have. Dealers will have no inventory. You'll be chasing prices higher while kicking yourself for giving up metal you already owned. Physical silver is your core position, your foundation. Hold it through the volatility. Add to it if we crash, and you have available cash. Third principle, have cash ready for the crash scenario. If we do crash toward $50, you want to be a buyer, not someone panicking and selling. Think about the people who bought silver at $65 when it hit that low on Thursday. They saw immediate 20% gains as price rebounded to $77. The next low could provide an even more dramatic opportunity. Keep a significant portion of your investable funds in cash, not invested, not committed, just sitting ready until we see which scenario unfolds. If we spike to 100, yes, you'll miss some upside because that cash wasn't invested, but you'll still profit handsomely on your existing holdings, and you'll be glad you have cash available for the next opportunity. If we crash, you can buy aggressively at potentially the lowest prices we'll see in this entire bull market. $50 silver with the fundamentals we have right now would be an absolute gift. Having cash ready means you can take advantage of that gift instead of watching helplessly from the sidelines. Fourth principle, watch specific price levels for confirmation of which direction we're heading. On the downside, watch $72 as initial support. If we break below that with strong volume, it suggests the selling pressure is resuming. Below 72, the next level to watch is $65, which was Thursday's low. If we take out 65 decisively, it confirms the crash scenario is active, and we're headed toward the $58 to $60 zone. A clean break below 65 with heavy volume tells you the bearish scenario is playing out, and you should be preparing to buy aggressively if you have cash ready. On the upside, watch $80 as initial resistance. If we can push through 80 with conviction, the next level is $85, which was support before the crash happened. Above 85, we're looking at $90 and then 100. A decisive break above 85 with strong volume confirms the explosive scenario is active. That's when shorts really start to panic, when the gamma squeeze accelerates, when everyone who sold in fear starts buying back in greed and FOMO. Those are the levels that matter. Watching price without reference to these key levels is just noise. These levels give you the structure to understand what the market is telling you. Fifth principle, prepare yourself mentally for extreme outcomes. This might actually be the most important principle of all, because your emotional state when Monday arrives will determine whether you make rational decisions or emotional ones. You need to accept right now, today, that silver could be at $50 when you wake up Monday morning. Really visualize that. Think about how you'll feel. Will you panic? Will you sell? Or will you recognize it as the opportunity it would represent? Also accept that silver could be at $90 Monday morning. Visualize that too. Will you chase it? Will you use leverage to try to catch the move? Or will you be disciplined and stick to your plan? By mentally rehearsing both scenarios now, while markets are closed and you're not under pressure, you prepare yourself to respond rationally instead of emotionally when the moment actually arrives. Let me tell you what to watch Sunday night, because futures markets open Sunday evening United States time, and those first few minutes of trading will give you a preview of what Monday brings. The futures open will show you where the big money is positioning. If futures gap up more than 3% from Friday's close, the bullish scenario is likely triggering. Buying pressure is overwhelming seller resistance. Shorts are scrambling to cover. The explosion toward $100 may be beginning right in front of your eyes. If futures gap down more than 3% from Friday's close, the bearish scenario is likely triggering. Selling pressure is returning. The crash is resuming. The decline toward $50 may be starting its second leg. If futures open relatively flat, within 2% of Friday's close, we might see continued consolidation before the big move triggers. But honestly, given current conditions, a flat open seems less likely than a gap move in one direction or the other. Set price alerts on your phone for these key levels so you get notified immediately when futures start moving. Be prepared to check futures Sunday evening. You don't have to make trading decisions Sunday night, but having early information allows you to mentally prepare for what Monday will bring. You won't be shocked when you wake up Monday morning because you'll already know which way the wind is blowing. Let me give you my honest assessment of the probabilities here, because you deserve transparency rather than false certainty. Based on everything I'm seeing in the data, in the price action, in the physical market dynamics, and in the technical setup, I estimate roughly a 40% probability that we continue declining toward $50 or $55. The crash was severe. The technical damage is real. Leverage hasn't been fully purged from the system yet. The conditions for a second leg down absolutely exist, and we can't ignore that possibility. I estimate roughly a 45% probability that we continue rebounding toward $90 to $100. Physical premiums are absolutely screaming that the crash was artificial, driven by paper market mechanics rather than actual supply and demand fundamentals. The rebound strength suggests serious buyers are stepping in aggressively. The long-term fundamentals haven't changed at all. The supply deficit is still real. Industrial demand is still growing. The conditions for an explosive rally exist and may actually be more probable than another leg down. I estimate roughly a 15% probability that we just consolidate in the $70 to $85 range for a while. The market could take time to digest what happened, to rebuild positions carefully, to wait for more clarity about economic conditions and geopolitical developments. This is the least exciting outcome, but it's possible. These probabilities represent my best estimate based on current information. They're not predictions, they're probability assessments, and they will change as conditions change. New information this weekend could shift these probabilities dramatically. That's why staying informed matters. That's why you need to be checking for updates, watching what happens in currency markets, paying attention to any news that could impact precious metals when trading resumes. Now let me address what this means for the bigger picture, because maintaining perspective is crucial when you're in the middle of market chaos. Whether we crash to $50 or spike to $100 in the next week, the long-term thesis for silver remains completely intact. The supply deficit that's been building for years is real. It hasn't gone away. Industrial demand for silver is growing because of electrification, solar panels, electric vehicles, 5G technology, and countless other applications where silver's unique properties make it irreplaceable. Mine supply is constrained because it takes years to bring new mines online, and existing mines are depleting. The critical mineral designation that governments have given silver reflects the strategic importance of this metal. Chinese export restrictions on antimony and other related metals continue. These fundamentals didn't change on Thursday when silver crashed. They won't change on Monday regardless of which direction price moves. If we crash to $50, it doesn't invalidate the long-term thesis. It just gives you dramatically better prices to accumulate physical metal. The bull market wouldn't be over. It would be entering what might turn out to be the final shakeout before the biggest rally phase, the phase where silver catches up to gold, where the decades-long suppression breaks down completely, where prices reach levels that seem absurd right now but will seem obvious in hindsight. A spike to $100 wouldn't complete the bull market either. The fundamentals support much higher prices over the next several years. $100 would be a waypoint, not the destination. The supply deficit and demand dynamics that serious analysts have documented support prices of 150, 200, possibly even higher as this cycle matures, and the reality of silver scarcity becomes impossible to ignore. What matters most is that you survive the volatility and remain positioned for the long-term move that's coming. Selling physical silver at $50 in panic would be a fatal mistake, the kind of mistake you'd regret for the rest of your investment life. You'd be selling the bottom, handing your metal to someone with stronger hands and a longer time horizon at exactly the worst possible moment. Chasing silver at $100 with leverage would also be dangerous because we could see a sharp pullback from those levels, and leverage would get you liquidated on that pullback even if the long-term direction is still higher. The optimal strategy, the one that gives you the best chance of success regardless of short-term price action, is patient accumulation of physical silver with a long time horizon. Buy when you have available funds and prices are reasonable. Hold through volatility. Don't try to trade in and out. Don't use leverage to amplify returns. Just steadily build a position in physical metal that you can hold for years through whatever wild price swings happen along the way. That strategy works whether Monday brings $50 or $100. It works whether this correction takes another month or ends next week. It works because it's aligned with the fundamental reality of a metal in deficit being demanded by industries that have no substitute. The next 48 hours are going to be intense. The next week could be absolutely historic, but your job isn't to predict every twist and turn. Your job is to position yourself wisely based on sound principles, hold your physical silver with confidence, eliminate any leverage that could get you killed in a gap move, keep cash ready in case we get a gift in the form of much lower prices. Prepare yourself mentally for extreme outcomes so you don't make emotional decisions when they arrive. Watch the key price levels that will tell you which scenario is unfolding. And whatever happens Monday, whatever gap we see when markets open, whatever chaos ensues during that first trading session, do not let emotion drive your decisions. Fear and greed are the enemies of successful investing. Discipline and patience are your allies. I'll be monitoring this situation throughout the weekend and posting updates immediately if anything significant develops. If there's news that changes the probability assessment, you'll hear about it. If there are developments that suggest one scenario is becoming more likely than the other, I'll share that information as soon as I have it. Drop a comment and tell me which scenario you think is most likely and how you're positioning for Monday. Share this with every silver investor you know, because this information could save them from making catastrophic mistakes or help them capture an incredible opportunity. 48 hours until we know. $50 or $100. The resolution is coming, and it's coming fast. Make sure you're ready for whatever that resolution turns out to be.